Okay, so I need one of you to help us read the question again so that we can solve the B parts. We have calculated the project specific as required in the A part of the question in our last class. So today we are going to do B and C of the question so that we can move to a brand new area of the scope for today. Right? I need one of you to help us read so that we can pick some variables that we need in the question. Yes, who is helping us? Yeah. Who is helping us to read? Yes. My volume is down. Charity, how about now? Charity, can you hear me clearly now? Still the same.
Yes, sir. Maybe I should just leave and come back again.
Okay. Let me find out from others. Hello, can you hear me clearly?
Yes, sir.
Oh, okay. In that case, Charity, you can just exit, then join again. Yes, I need somebody to help us read the question. Who is helping us? Who will be
Telemundo PLC.
Okay, thank you.
Telemundo PLC is a company listed on the Nigeria Stock Exchange. It is involved in property development and sales. The company currently imports more than 60% of its cement requirements. At a recent meeting of the board of directors, the decision was taken to establish a division for the production of cement in Ore, Ondo State. If the division is set up and the cement production goes ahead, output from the division will be sold to Telemundo PLC and external customer at market price. For planning purpose, it has been decided that the financial availability of the project over the next 5 years should be determined. The sum of 2 billion naira will be required. The sum of 5 million naira will be spent to acquire an existing factory considered suitable for the project. The balance of 1.5 billion will be applied for the procurement and installation of essential plants and equipment. Tax allowance can be claimed and plant and equipment at a uniform amount over 5 years with new scrap value. A total of 20 million has been spent on various surveys, market, technical, financial, etc. to date, out of which 10 million has been paid. The balance of 10 million is due for payment at the end of year 1. Production of cement for the next 5 years is projected as follows: year 1 to 5, all figures are assumed to be correct. A bag of cement sells currently at 2,000 naira in the open market. This price is expected to increase at the rate of 5% per annum. The variable cost is now 800 naira per bag. This will increase at 4% per annum. Fixed overhead costs will be 50 million at current prices, but will rise by 8% per annum. Apportioned head charges of 25 million naira at current price will be raised by 10% per annum. 50% of the total initial outlay of 2 billion naira is to be funded with a loan from a federal government development bank at a concessional fixed interest rate of 8%, payable at the end of 5 years. The project will require a working capital of 10% of annual revenue, and this should be available at the beginning of each year. The company uses a current weighted average cost of capital of 11% to appraise all capital projects. The asset beta of the company is 1.2, equity beta is 1.6, risk-free rate is 5%, while the market risk premium is 7%. The finance director is of the view that it is not appropriate to use the existing WACC to appraise the new project. He has identified a listed company which currently produces cement and packaged fruit drinks. The company has the following financial statistics: equity beta 1.82, debt beta 0.40, debt/equity ratio 40%. 60% of the market value of the company is attributed to cement production, while 40% of the value is attributed to the fruit drink division. The fruit drink division has an equity beta of 0.8. The new project is expected to move Telemundo PLC to the target debt/equity ratio of 30%. The tax rate is 25% of the two companies and is paid in the year profit is made.
All right. Thank you very much. Yeah, thank you very much, Uju. Appreciate. Yes. Last week we have solved the A parts. We calculated the project specific cost of capital, and then today we are going to do only the B and C. In the B requirements, examiner is asking you to compute the net present value and then modified internal rate of return of the project, assuming a cost of capital of 13%. So you want to this question is very direct, and examiner is asking you to calculate net present value and then modified internal rate of return. All figures should be rounded to the nearest million. So if that is the case, let me stop sharing this and move to the working notes. You already have access to the question because it's in the SFM group. If you don't have access to it, you can ask anybody from the group to share with you. All right. So quickly, and if you also have the golden book, you can just open it at your hand. So no worries. Let's move on from here. Let me stop sharing this and move to the working notes straight. Yeah. Okay. So we want to calculate net present value. So first thing first, I need to state the name of the company if given to you. Here is Telemundo PLC. So this is just a continuation from where we stopped last week. So this is requirement number B, Roman figure 1. What do you want to do? We want to calculate the net present value. So examiner has told us that all figures should be rounded up to a million. All right. Thank you for holding on. Initially I was battling with my pen and the PC. Couldn't connect. So anyway, let's move on. Yes. The name of the company is Telemundo PLC. So solution to requirement number B1. We want to calculate net present value. Okay. Examiner has instructed that all figures should be rounded to a million. All right. I will then go back to the question. What's the useful life of this project? According to the question, examiner has told us that the project, of course, is for 5 years. All right. Again, I need to check from the question how tax will be paid. Is tax going to be paid in the current year or in arrears? In the last paragraph, before the requirements, examiner has told us that the tax rate is 25% for the two companies and is paid in the year profit is made. All right. So in that case, I will create a column for year 0, year 1, year 2, year 3, year 4, then year 5. So you can create additional column for workings. All right. So we have a format for calculating NPV when you have multiple variables. Because as far as this question is concerned, we have revenue, we have variable cost. Foreman, please mute. In the question, we have revenue, we have variable cost, we have fixed cost, we have working capital, we have inflation, we have taxation. So we have multiple variables. As a result, we are going to use this columnar format. So based on the format, the first item on the list is sales value. So we then go and do working for our sales. So the NPV is for this page. Modified internal rate of return is for the second page. Then working will start from here. We did some workings last week, okay, but let's start afresh. So to do this, I'll indicate the years. Year 1, year 2, year 3, year 4, and then year 5. All right, so I need number of units. According to the question, the first year says volume of the bag of cement is 500,000, followed by 600,000, 650, okay, 500,000, 600,000, 650, then year 4 is 800, then 700, 800,000, then 700,000. So these are the units produced and sold. So working number 1, I want to determine sales. How am I going to get my sales? Sales is selling price multiplied by units sold. Therefore, I will then go to the question. What's the selling price? According to the question, examiner has told us that a bag of cement sells currently for 2,000 naira in the open market. Pay attention, please. Examiner has told us that this bag of cement is sold for 2,000 naira currently. So examiner mentioned currently. It means that 2,000 naira is a real cash flow, because real cash flow are stated in today's prices, year 0 prices, and first year prices and current value terms. All right. So examiner told you that a bag of cement sells currently for 2,000 naira, which means it's a real cash flow. And I mentioned to you that when cash flow are stated in today's prices, year 0 prices, or current value terms, inflation should start from year 1. So selling price of 2,000 naira, then inflation rate for selling price, we are told is 5% per annum. Therefore, we are going to grow the 2,000 naira at 5%. Okay, so selling price at 5%. So I will then carry my calculator. Let me do it this way. 2,000 at 5%. Okay, so I will then carry my calculator to say 1.05 multiplied by 2,000. 2,100. Then 2,100, what you have in your calculator multiplied by 1.05. 2,205. What you have in your calculator multiplied by 1.05. 2,315. Multiplied by 1.05 equal 2,431. And the last one, what you have in your calculator multiplied by 1.05. That's 2,553. 2,553. So with this, we have inflated the selling price. You can see that 2,000 naira does not occur in year one because you need to start inflating from that year one. Why? Because the selling price is stated in current value terms. When cash flow are stated in current value terms, inflation should start from year one. You should start inflating from year one. And that's why I did not put 2,000 naira in year one. Okay? So the next thing we need to do is to determine the total sales. All right? Our figures are in million. So let's say this is, let me adjust this a little bit, push this one to the front so that I can add space. So let's say this is B. All right, this is A. All right, so I would then say A multiplied by B to get my total sales. A multiplied by B. So in this case, the first item is 500,000. So 500,000 multiplied by 2,1. That's 1050. Figures are in million. So here is 1050. Next one, 600,000
323.
multiplied by 2,205. That's 1,323. 650,000 multiplied by 2,315. That's 1,505. Next one, 800,000 multiplied by 2,431. That's 1,945. Next one, 700,000 multiplied by 2,553. That's 1,787. So with this, we have calculated our sales. Yes, Zoom user. Go ahead with your question.
Sorry,
Zoom user.
I've had my hand before.
What's your question? Okay.
Sorry, I've had my hand up for a while. I want to go back because I missed what you said earlier, but I didn't want to interrupt you. Before we go to these sales, you said something about cash flow, then we'll start from year one. So I wanted to take that down, but you were actually fast.
I was fast.
Yes.
Okay. You know, okay. You know, this is not the first time I've said this same issue. I've said it severally in our previous calculations. You know, so I'm just repeating, I'm just re-echoing what I've said in the past. In any case, what I'm saying is that when cash flow are stated in today's prices, year zero prices, or current value times, inflation should start from year one. All right. Because in the question, the examiner told us that selling price says currently for 2,000 naira. So because examiner has told you that selling price is in current value terms, that means we should start inflating from year one. And that's why you see that we did not use 2,000 naira in year one, because 2,000 naira is in current value terms. All right. But if you are told in the question that cash flows is stated in year one prices or first year prices, then inflation should start from year two. And I said that the fact that I said inflation should start from year two does not mean that your n will be equal to 2. Your n will still remain 1. All right. When you look at the question we solved under Washington, no, Washington is in current value term. Under Ferrari, all right, last week, you will notice that in that one, we started inflating from year two. Okay, so I believe that is clear. Zoom user. Zoom user, are you satisfied? I didn't get you.
I said yes, thank you, sir.
Okay. All right then. So let's move on. Now we have computed our sales value. So the next thing we want to calculate is the variable cost. Okay. So to get the variable cost, I will then go back to the question to go and identify where variable cost is mentioned in the question. See, still on the same paragraph, you are told that the variable cost is now 800 naira per bag. Again, examiner has mentioned now. Now means that means that 800 naira is a real cash flow. Now means you have to start inflating from year one, because I just mentioned it. When cash flow are stated in today's prices, okay, year zero prices or current value terms, that means you need to start inflating from year one. So if examiner does not call it today, it can be called now or immediately. So whichever of the three examiners used is still the same thing. I repeat, examiner can call it today, now, or immediately. So whichever one is the same thing. So what's the inflation rate for variable costs? We are told that this will increase at 4% per annum. So inflation on the variable cost is 4%. So I will go and do working for my variable cost. Working number 2, total variable cost. Let me do it this way, in million. All right. So variable costs, we are told is 800 naira at inflation rate of 4%. This 800 naira is now, which means that we should start inflating from year one. Therefore, I will then carry my calculator, 1.04 multiplied by 800. That's 832. What you have in your calculator, multiplied by 1.04 equal 865. What you have in your calculator, multiplied by 1.04 equal 900. That's 899.89, so 900. What you have showing on your calculator, multiplied by 1.04 equal 936. The last one, then multiply by 1.04. That's 973. Okay, so that's the inflated variable cost. So we need to multiply, let's say this is C. So we need to multiply to get the total variable cost. This should be A multiplied by C. All right, so the units produced in the first year is 500. 500,000, okay, multiplied by 832 equal 416 million. Wumi, are you in this class? If you are in the class and you allow me struggling to be picking number like this, then you are not a good partner for tonight. You need to change. All right?
519.
519, okay. Next one.
Apologies, sir. I got home drenched in the rain.
585.
I can imagine. 585. Bele. Next one.
Oh my goodness.
749.
749. And the last one.
681.
681. So let's go and post. Okay. Here is 681. Working number 2. Year 1 is 416.
51982.
519 for year 2.
585.
585 for year 3.
749.
749.
Then 749 for year 4. Okay. So I will go back to the question again and identify other relevant cash flows. After variable costs, still on the same paragraph, you are told that fixed overhead costs will be 50 million naira at current prices, but will rise by 8% per annum. So, examiner has given you fixed overhead to be 50 million naira. You need to identify, you need to check whether this 50 million naira is relevant or irrelevant. Of course, examiner has told you that the fixed overhead will be 50 million. That means it's a future cost. So the company has not incurred the fixed overhead. Therefore, that 50 million naira is relevant because it's a future cost. Therefore, the inflation rate is 8%. I would then say I will just increase that by 8%. So in this case, I don't need to go and be working for fixed overhead. I will just come here, fixed overhead. Inflation rate is 8%. All right. Okay, it's 8%. So I will just say 50 million multiplied by 1.08. All right. So 50, excuse me, 50 multiplied by 1.08. That will give us 54. Okay. After that, what you have in your calculator, multiply by 1.08.
8.
That's 58. Rounding. Again, what you have in your calculator, multiply by 1.08.
63.
63.
All right. That's 63.
68.
68.
73.
And then 73. That's it. That's it. Okay. Let me just make it more. Okay. Fixed cost 2,000 at 8%. so that you under sorry, I said 2,000.
50 million.
50 million. Fixed overhead. Okay. So that's that. Then I need to go back to the question and check if we have other relevant cash flows. So on that same paragraph, examiner has told you that apportioned charges of 25 million naira at current prices will rise by 10% per annum. Head office charges is head office allocation. So it's not a future cost. That one is not relevant. Anything apportionment is irrelevant cost. For those of you that did performance management, you would have known that any apportionment is irrelevant cash flow and then should be ignored. Therefore, the 25 million naira is not relevant to our calculation. Next, 50% of the total initial outlay of 2 billion naira is to be funded with a loan from a federal government development bank at a concessional fixed interest rate of 8%, payable at the end of year 5. Again, we are calculating NPV. We are less concerned with the method of financing a project. When you want to know about method of financing a project, then we should be talking about adjusted present value. But here we are calculating NPV. Therefore, we are less concerned with the method of financing. So you ignore that information. We don't need it for anything. All right. Next. Again, we are told that the project will require a working capital of 10% of annual revenue. Okay. Working capital will come much later. First of all, let's determine our profit. From our profit, we get our tax. From the tax, we get tax saved on capital allowance, initial outlay, working capital, then initial outlay, then working capital. So in this case, working capital will come much later. Not only that, when you go back to the question, in the second paragraph, in the third paragraph of the question, examiner mentioned to you that a total of 20 million naira has been spent on various surveys, including market, technical, financial, etc. to date, out of which 10 million naira has been paid. The balance of 10 million naira is due for payment at the end of year 1. So you can see, you are told that a total of 20 million naira has been spent on various surveys. That 20 million naira is a sunk cost. It's not relevant to our calculation, irrespective of when the payment will be made. Because in this question, the examiner told you that only 10,000 naira out of the 20 million, only 10,000 million has been paid. The balance of 10 million naira is due to be paid, because examiner is aware of limitation of some students. All right. Of course, some students will think that, okay, should be out of the 20 million, 10 million has been paid. The balance of 10 million naira has not been paid. So that balance of 10 million is relevant. When you do that, that will be, you'll be mistaken. Therefore, any past cost is irrelevant cost, irrespective of when the payment will be made. You know, when I was explaining the concept, we talk about sunk cost, and I gave you examples of sunk costs to include development costs, market survey costs, okay, research and development costs, feasibility study costs, all those costs, provided they have been the activity has been completed before commencement of the project, irrespective of when the payment will be made, is not relevant. It's a sunk cost. So this 20 million naira, we are going to ignore it because it's not relevant to our calculation. Okay, so other than that, every other information there, we have considered some of them. Let's move on. Okay, so at this point, we then need to determine our taxable profits. Okay. So find me the difference, please. This should be profits. What's the profit for year 1?
580.
Did you say 580?
That's correct, sir.
Next one.
46.
746.
746.
857.
5
Year 5 is what?
1,000 and 1,033.
1043.
No, 33.
33.
Yes, sir.
1033. Okay.
Year 4, 1128.
11 words.
28.
1118. Okay.
28. 1128.
All right.
Year 3,
Yeah. Yep.
857.
So that should be 1128, not 118.
857.
Yes, 857.
857. Okay, then. So, if that is the case, now that you have determined the profits, so the company will need to pay tax on these profits. Therefore, the next item after profit is tax. Examiner told us in the question that both companies should pay tax of 25%. Okay, so tax at 25%. So according to the question, examiner told us that tax are paid in the year the profit is earned. So that means in the current year. Therefore, you need to get 580 multiplied by 25%. Okay.
145.
145.
145.
187.
187.
214.
214.
282.
282.
258.
258. All right. So immediately after tax liability, we need to consider tax saved on capital allowance. So let's go and do working for that. Tax saved on capital allowance. Okay. Capital allowance. So I will then go back to the question. How are we going to claim our capital allowance? So according to the question, let's see, where do you have information on tax on the capital allowance? Okay. If you go to the second paragraph, examiner has told you that tax allowance can be claimed on plant and equipment at a uniform amount over 5 years with a new scrap value. Pay attention to this. Now, in the question, in that same paragraph, you are told that the sum of 2 billion naira will be required. That 2 billion naira is initial outlay. All right. The sum of 500 million naira will be spent to acquire an existing factory considered suitable for the project. You can see out of the 2 billion, 500 million is meant for acquisition of existing factory considered suitable for the project. That 500 million area does not qualify for capital allowance. Why? Because it's an existing asset. The original owner of the asset might have been claiming capital allowance. And capital allowance is not something you can transfer to a new owner or you can transfer to a new user. Therefore, we cannot claim capital allowance again on that 500. And that's what examiner was telling you that, okay, tax allowance can be claimed on the plant and equipment, which cost 1.5 billion naira. So we are only going to calculate on the 1.5 billion. You don't calculate capital allowance on the existing asset because that existing asset does not qualify. Okay, does not qualify for capital allowance. Now, examiner has told you that this capital allowance is on a straight line basis over the 5 years period, and then scrap value is 0. So if that is the case, let's calculate our capital allowance. Again, in this case, since capital allowance is on a straight line basis and scrap value is nil, so I don't need to waste my time to be using that table format that I gave to you. So just come here, capital allowance will be calculated as the cost minus scrap value divided by useful life. Let me write it out in full. Scrap value. Okay. So divided by useful life of the assets. Okay. Then multiply by the company tax rates. All right. So since the company said it's on a it's on a straight line basis. So the cost is 1,500. Our figures are in million. All right. Then scrap value we are told is 0. So useful life, according to the question, is 5 years. Therefore, annual capital allowance of this asset will then be 300 million. 300 million is the annual capital allowance. So to now get the tax saved will be equal to capital allowance multiplied by the company tax rates. Okay, so 300 million, company tax rate is 25%. All right, so this will give us 75, I think, yeah, 75 million per annum. So tax saved is 75 million naira per annum. So that's that. I will then come here, 75 for each year. 75, 75, 75, and then 75. It's a claim that will reduce the tax liability the company will pay. After tax saved, the next item will be scrap value. Since the examiner told us scrap value is nil, so don't need to write anything there. I would then say initial outlay. Initially, according to the question, is 2 billion naira. Figures are in million. Next one, working capital. So let's go back to the question on how are we going to calculate our working capital? Yes, according to the question, we are told that the project will require a working capital of 10% of annual revenue, and this will be available at the beginning of each year. So working capital is 10% of annual revenue. So let's go and do working for that. Working number 4, working capital. Okay. So year 1, year 2, year 3, 4, and then 5. Then we have total. So working capital is 10% of annual revenue. So I would then say working capital at 10% of revenue of sales. Let me call it sales. Okay. So based on our calculation previously, year 1 sales is 1050. 10% of 1050 will give us 105. Here will be 105. Year 2 sales is 1323. 10% of that is 132. Year 3 says is 1505. 10% of that is 151. In year 4, annual sales is 1945, right? 10% of that is 195. In year 5, which is the final year, annual sale is 1787. 10% of that is 179. 179. Okay, so you see that from year 1 up to year 4, working capital is increasing, right? Working capital has increased from 105 million to 179 in year 4. In year 5, the working capital starts dropping, start falling. Now, pay attention to what I'm about to say. First thing first, you need to determine the incremental working capital, because you can see the highest between year 1 and year 5, the highest working capital is 195. So the highest working capital is 195. But when you look at year 5 working capital, which is 179, it has reduced. So the reason being that it means that the company has recovered part of the working capital. So when working capital is increasing and it started falling at a particular year, it means that the company has recovered part of the working capital. All right, I will give it to you as a note so that you don't forget it. But first thing first, let's determine the incremental working capital. The first year is 105. Okay, so from 105 to 132, 105 minus 132, that's 27. That's an increase of 27. Then 132
19.
minus 151,
19.
19. Then
44.
151 minus 195, that's 44. 195 minus 179, that should be 16. Okay. All right. 179 minus 0 will give us 179. Okay, that's that. So again, pay attention. Relevant year. Now, like I mentioned, in that year 4, the highest working capital is 195, which occurs in year 5, in year 4. So it has dropped to 179 in year 5. It means that the company has recovered 16 million out of the 195. So what I'm now telling you is that, okay, let me just put it down. Notes. When working capital is increasing, and it starts falling at a particular year, it means, let me write that. It means the company has recovered part of the working capital. Okay. So that's what has happened in that year 5, where you have 16 million. Okay, 16 million has been recovered out of the 195. So the rule says that working capital should be treated as a cash outflow in the year before the year of occurrence, and then recover fully at the end of the useful life. The one of year 1, that 105 will be treated as cash outflow in year 0, year 1, year 2, year 3. In year 4, we have recovered 60 million. Then the balance of the 195, which is 179, will be recovered in year 5. So that is as per our calculation on the working capital. So 105.27, 105.27. Here is 105.27. Next one, I think it's 19. 19.
44.
44.
16.
16, and then 179. That's working number 4. So that's that. At this point, we need to determine the net cash flow. Here is 2105. Okay. Here is net cash flow. Okay. Year 1.
483.
483.
615.
615. I think this one is 930 or 7 something. Year 4. Year 4 is 937.
674.
Pardon?
67483.
674. Okay. And the final year.
1029.
1029. Okay, so that's that. So the next thing we need to do now is to discount the cash flows. So discount factor, according to the question, the examiner asked us to assume 13% as our cost of capital. We are to use 13%. So here is 13%. So discount factor for year 1 at 13%, what you get? 1.13 raised to power 1 minus, that's 0.885. For year 2, 1.1,
783.
pardon?
0.783.
0.783. Year 3,
0.693.
year 4,
0.613.
and the final year,
0.542. 543.
543. So let's multiply to get the present value.
Four to seven. Year 1.
427.
Year 5, 559.
559.
Year 2, 482.
482.
467.
467.
574.
574. So let's add everything together and the minus 2105. What's the NPV?
404.
404. Positive or negative?
Positive.
Okay then. So yes, in the B requirements, you are only asked to compute NPV and then modified internal rate of return. You are not asked to advise the recommendation will come at number C, requirement. So let's calculate modified internal rate of return. So number B, high, calculating modified internal rate of return. Now, to calculate modified internal rate of return, I gave you two different formulas. Whichever of the two formulas that you use, you are going to get the same answer. However, anytime you have calculated MPV and you are now asked to calculate modified internal rate of return, you need to use the big for nothing formula, the second formula I gave to you. That's what you should use to get your MPV. It will make life easy for you. So to get your modified internal rate of return. So instead of calculating terminal value for all the positive cash flow, you can calculate present value for all the negative cash flow. It's a waste of time. Just go ahead. You've already calculated NPV, you already calculated present value. So just go ahead and use that big for nothing formula. So in this case, I will just say modified internal rate of return equal to the present value of cash inflow over present value of cash outflow. All of this raised to power 1 over n multiplied by 1 plus the cost of capital. Okay, then everything minus 1. Of course, you are supposed to multiply everything by 100%. Okay, so that is the formula. Again, on the day of your exam, this formula, you are going to see it at the back of your question paper. It is called present value of return phase, present value of investment phase. I've already explained this to you when I was giving you the note. Present value of cash inflow is the same thing as present value of return phase. All right, present value of cash outflow is the same thing as present value of investment phase. All right, because there are two stages, there are two phases of a project. The first phase is when the company is spending money on the project. That is the development phase or investment phase. The second phase is when the company is reaping the benefit from the investments. That's when the company is benefiting, is reaping, the project will begin to generate cash inflow. All right, so that's that. Then I would then say modified internal rate of return equal. We have calculated present value of cash inflow. Before we got this NPV of 404 million, we added up the positive present value. We net off 2105 and we got the 404 NPV. So for me to get my present, instead of me to be calculating present value again, 427 plus 482 plus 460, all those ones, it's a waste of time. I will just come here. Present value of cash inflow would then be 2105 plus the NPV that I've calculated, which is 404, divided by present value of cash outflow, 2105. So all of this raised to power 1 over 5. Let me write that 5. 1 over 5, then multiply by R is the cost of capital of 13%, therefore 1.13. All of this minus 1. You can see there's nothing there. It's just big for nothing. Nothing there. All right. So in this case, I will then come here. Modified internal rate of return equal, right? So 2105 plus 404, that will give us 2509. 2509 over
2105.
2105. 1 divided by 5 will give us 0.2. So raised to power 0.2 multiplied by 1.13, all minus 1. So I'll just use calculator and get the final answer. It's as simple as that. So modified internal rate of return would then be equal to, examiner said we should round our number to final figure. So in this case, I will just say 2509 divided by 2105 equal, then raised to power 0.2 equal multiply by 1.13 equal, then minus 1 equal to multiply by 100%. That's 17.04%. 17.04%, approximately 17%. Okay, that is our modified internal rate of return. Then finally, before you move to the C part of the question, you must state your assumption. You can never earn that 16 marks. You can't earn the 16 marks in the B requirement if you don't state your assumption. So it's not sufficient for you to have done wonderfully well, calculate your NPV and you got 404 million and then you just stop there. No, you have to state your assumption before we move to C. You state your assumption. So I can then say B high assumptions. Again, we have done several assumptions in our previous examples. So I'll just mention what you need to do. I don't have space here. So let me so to state your assumption, we talk about, again, I've already explained to you. In the question, we have cash flow. So you need to talk about cash flow. 2, in the question, we are given cost of capital of 13%. Then what's your assumption on the cost of capital? You need to state it. You can see in this question, the examiner did not ask you to state your assumption, but it is implied. It's implied that you know what you are doing. So you don't need the examiner to tell you. It's the normal thing that you must do. Don't be in a rush. Number 3, if in the question you are given inflation, then you need to talk about it. Again, we have inflation in this question. Number 4, in this question, we are given market survey costs. Okay, we are given market survey, different kind of survey, technical. Let me go back to the question again. Examiner mentioned, yes, market, technical, and financial surveys. Okay, so 20 million. That one also we said is sunk cost. So you need to talk about sunk cost. Number 5, in this question, we are given head office charges. Okay, why did you ignore the head office charges of 25 million? Why did you ignore it? Okay, so you talk about it. If you like, you can talk about interest of funding method. Okay, so these are the areas you need to talk about. If you already talk about cash flow, what do I mean by cash flow? It is assumed that all the cash flow estimates are realistic and will occur at the end of each year. All cash flows have been inflated at the appropriate inflation rate. That's all. You hang your mark on that. Then number 2, we talk about cost of capital. Cost of capital of 13% is assumed to be appropriate and consistent with the risk associated with the project and cash flow. All right. Our assumption is that 13% cost of capital given to us is appropriate and consistent with the risk associated with this project and also with the cash flow, because money cash flow for money cost of capital. That's what we have done. Then you talk about inflation. What do you mean by inflation? We are given different inflation rates. That means there are specific inflation rates. So they can then talk about, you can say the specific inflation rates are assumed, okay, the specific inflation rates are assumed to remain constant within the relevant range. Otherwise, the decision to accept the project may change, because in this question, you have variable costs and the inflation rate on your variable cost is 4%. You have fixed cost. Inflation rate on your fixed cost is 8%. You have revenue. Inflation rate on your revenue is 5%. That means you are given specific inflation rate. So our assumption is that those inflation rates will remain constant within the relevant range. It will not change. You can imagine if the inflation rate on variable cost and fixed overhead increase, all right, that means our decision to accept the project may change because it is possible your NPV may become negative. That means the project will not be viable. Then number 4 is sunk cost. You then say the market survey cost of 20 million naira of 20 is it 20 yes 20 million naira is a past cost and therefore not relevant to the calculation. Okay, so that's our assumption on that. Then number 5, we talk about head office charges. The apportioned head office charges of 25 million naira is irrelevant, irrespective, because it will be incurred irrespective of the decision made on this project. Or you can just simply put the apportioned head office charges of 25 million naira is not relevant to the calculation and therefore ignored. That's all. Then if you like, you can talk about interest. The interest rate of 8%, the interest rate of 8% is not relevant to the calculation, and this has been ignored. Okay, so that's that. That's all you need to do. All right, I believe that's then you can move to the number C part. Examiner is asking you to advise. So what are you supposed to say? What are you supposed to say? Of course, our NPV is our NPV is positive, which means that the project is financially viable. Okay, you have to recommend whether the project should be accepted or not using both NPV and then modified internal rate of return. If you advise on the basis of NPV alone, all right, if you recommend on the basis of NPV alone, you may not earn your full 3 marks in that requirement. So examiner says you should use both NPV and then modify internal rate of return for your recommendation. Okay, so what are you supposed to say? Now, I will then say the project produced a positive NPV of 404 million naira and modified internal rate of return of approximately 17% of approximately percent relative to the company's cost of capital, relative to the, let me write this one, company's cost of capital of 13%. Because examiner says you should use 13% for your calculation. Let me even go back to the question. What's the company's cost of capital? I think we are given 11% somewhere. Let me check. Yes, the company uses a current weighted average cost of capital of 11% to appraise. So the cost of capital is 11. So relative to the company's cost of capital of 11%. Okay. Therefore, the project is financially viable and should be accepted Okay, that's that. That's our recommendation. 3 marks, you pocket it. Okay, sorry, it's even 2 marks. All right, it's 2 marks. That's a bonus 2 marks. All right. Let me know if you have any question for me. Other than that, let's move to adjusted present value. Any question? I'm fast. Okay. Charity. Hope you are able to recover. All right. So in the absence of no further question, that's end of capital budgeting. I think we solved 4 different illustrations. We solved the question on True Talk, Washington PSC, Ferrari PSC, and now Telemundo PSC. We solved 4 different illustrations. Please, we advise you, go ahead and practice as many questions as possible, because the more questions you practice, the more experience you are going to gain. All right. So please try as much as possible. Go ahead and practice different scenario questions so that on that day, it is possible you may see similar illustration or scenario question that you have seen in the past, that you have experienced in the past. So that will help you a lot. Okay, it will help you a lot. So just go ahead and solve as many questions as possible so that you can be well grounded. And then this question of the last question in your study material, I think that's illustration number 7. Femi appliances. Okay, Femi appliances. You can go and try that question as well. If because of time, I could not solve it because we have a lot to do. We still have so much outstanding for us to cover. So I can't solve as many questions as possible. So try as much to go through your study materials, um, go to Pathfinder question and answers, go and practice that last illustration. I think it was tested in 2021. I can't remember. Was it 2021? I can't remember. Just go there and go and practice the question. And if you have access to the Golden Book, this is the same question as the Bulala Limited. That's the same question. So in that question, you are asked to calculate internal rate of return. So if you have the Golden Book, just go ahead and solve the question on your own. Don't check the solution. Just solve the question on your own first. Then you can now review so how I treated the question, so that you'll be able to see, okay, in case you never can tell, you have similar question on the day of your exam. You know, when you are when you see on the day of your exam, when you see question you are familiar with, it will help you a lot. In fact, to boost your confidence, it won't take you time for you to solve. So please take your time, solve as many questions as possible, all right? And then gain your experience preparatory to your exam. So this will be the end of capital budgeting. Let's spend the remaining hour that we have to discuss the concept of adjusted present value. So I will stop sharing this. Okay.